The investing decision that feels safe, but usually costs you money, lump sum versus DCA. If you invest money from every paycheck the moment it lands in your account, congratulations. You're already doing something that many people are too afraid to do with a large amount of money. You're already investing a lump sum. You just don't call it that. Now imagine something very different. Tomorrow morning, you wake up with $100,000. Maybe it's an inheritance, a work bonus, the sale of your house, money you've never had before. Suddenly, your confidence disappears, because now you have a decision. Option 1. Invest the entire $100,000 today. One click. Done. Option 2. Split it into 12 smaller investments. Around $8,300 every month for a year. This is called dollar cost averaging. Most people instinctively choose the second option. It feels safer. It feels smarter. It feels like you're reducing risk. But by the end of this video, you'll discover why that feeling can be incredibly misleading. You'll see what nearly 100 years of market data actually says. And you'll learn why the biggest risk often isn't investing too early. It's waiting too long. Here's something most investors never realize. When your salary arrives, and you invest it immediately, that is lump sum investing. Your money became available. You invested it immediately. That's exactly what a lump sum is. True dollar cost averaging is something different. It only happens when you already have all the money available, but deliberately leave part of it sitting in cash, because you're afraid of investing it today. That distinction changes everything. Because if investing immediately is already your normal behavior with every paycheck, why does the same decision suddenly feel terrifying when the number has an extra zero? The answer isn't mathematics. It's psychology. But before we get there, I want to know where you stand. Comment below. Team lump sum or team slow drip? Don't overthink it. Just go with your instinct. We'll see if the evidence changes your mind. Markets don't move upward every day, or every month. Sometimes they fall. Sometimes they crash. But over long periods, they have shown a remarkable upward trend. Historically, the U.S. stock market has finished positive in roughly 3 out of every 4 rolling 12-month periods. That upward bias matters, because every day your money waits in cash. It isn't participating in that growth. Vanguard wanted to test this. Instead of asking what feels safer, they asked a simple question. If someone already has a lump sum, should they invest it immediately? Or spread it out over time? Using decades of historical market data from the United States, the United Kingdom and Australia, they compared both strategies. The result was surprisingly consistent. Lump sum investing outperformed dollar cost averaging roughly 2/3 of the time. Across different countries, different decades, and different portfolio types. Over a 10-year period, the average advantage was around 2 to 2.5%. Not every time, not every market, but often enough that the evidence has remained remarkably consistent. In investing, time usually beats hesitation. Let's make this simple. Imagine 2 investors. Both receive exactly $100,000. Investor A invests everything today. Investor B decides to spread the money across the next 12 months. Assume the market earns its long-term historical average of around 10% annually. Investor A has the entire $100,000 working from day one. Every dollar starts compounding immediately. Investor B doesn't. During that first year, only part of the money is invested. On average, roughly half the cash is still sitting on the sidelines waiting for future purchases. Even if markets simply rise steadily, Investor A usually finishes that first year several $1,000s ahead. Nothing magical happened. No better stock picking. No market timing. Their money simply spent more time invested. Now stretch that advantage over 20 years. 30 years. 40 years. A few $1,000s becomes tens of thousands. Sometimes much more. Because compound interest rewards time, not perfection. Now let's address the obvious question. What if I invest everything today, and tomorrow the market crashes? That's a real possibility. And it's exactly why this debate exists. Take the dot-com bubble. An investor who bought the S&P 500 near its 2000 peak waited roughly 7 years before fully recovering. 7 years. Imagine opening your investment account every month for 7 years, still seeing less money than you started with. Or look at the global financial crisis. An investor who bought just before the crash in 2007 waited roughly 5 years to recover. That's emotionally exhausting. Which is why dollar cost averaging feels comforting. It creates the illusion of control. But here's the problem. A strategy only works if you actually follow it. When markets fall month after month, many investors become tempted to stop buying altogether. The headlines become terrifying. The fear feels real. And suddenly, the plan disappears. Now let's fast forward to 2020. COVID. The fastest bear market in modern history. The S&P 500 fell around 34%. In just over a month, the world shut down. Businesses closed. Millions lost their jobs. Every headline predicted something worse. People assumed recovery would take years. History suggested it might. Instead, something almost nobody expected happened. The dot-com crash took around 86 months to recover. The financial crisis took around 65 months. The COVID crash took about 6 months. Read that again. The fastest collapse also produced one of the fastest recoveries ever recorded. If you panic sold near the bottom, you locked in enormous losses. If you simply stayed invested, you recovered within months. And investors who continued buying through the panic were rewarded as markets recovered over the following years. The lesson isn't that every crash recovers quickly. Nobody knows when the next recovery will happen. The lesson is this: the market doesn't send invitations. Recovery begins while fear is still everywhere. If the evidence is so strong, why do so many people still prefer dollar cost averaging? Because your brain wasn't designed for investing. It was designed for survival. Behavioral economists describe two powerful biases. The first, loss aversion. Research suggests losing money feels roughly twice as painful as gaining the same amount feels good. Your brain exaggerates downside risk. The second, regret avoidance. Your brain isn't trying to maximize your retirement account. It's trying to prevent future embarrassment. It whispers, what if you invest today, and tomorrow everything crashes? Ironically, that fear often creates the bigger mistake. Waiting. Doing nothing. keeping cash on the sidelines while inflation quietly erodes its value. Now, let's be fair. Dollar cost averaging is not a bad strategy. There are situations where it makes perfect sense. First, if you're investing from your monthly salary, that's simply how cash arrives. There's no alternative. Second, if this money represents most of your life savings, and a large market decline would cause overwhelming emotional stress. Third, if you know yourself, if a 30% decline would cause you to panic, sell everything, and abandon your plan, then a strategy with slightly lower expected returns that you can consistently follow may actually produce better real-world results. The best strategy is the one you'll still be following during a bear market. Here's the approach I like for investors who are genuinely nervous. Invest half today. Immediately, your money starts working. Then automatically invest the remaining half over the next 3 months. Not a year. Not 2 years. Just 3 months. This approach captures most of the historical advantage of getting invested early, while reducing the emotional pressure of putting everything in on a single day. Most importantly, automate it. Make the decisions once, then let the process run. Because successful investing usually isn't about making brilliant decisions every week. It's about avoiding terrible emotional decisions during the few weeks that matter most. The biggest threat to your wealth isn't a market correction. It isn't a recession. It isn't even a bear market. It's hesitation. History shows that markets spend far more time rising than falling. And every day your money waits for the perfect moment is one less day it's working for you. So I want to ask you again. After seeing the evidence, are you still team slow drip? Or have you switched to team lump sum? Let me know in the comments. This is the Growth Blueprint. If this helped you, like the video. Subscribe for more evidence-based investing and self-growth content. And in the next video, I'll show you exactly how I'd invest a $100,000 portfolio from scratch using low-cost index funds.